second episode of Tech Wealth Chronicles, the podcast series where we break down markets, money, and everything in between. I'm your host, Sanat, and this is Vanisha. And today we are joined by Mr. Malay Shah, the co founder and principal advisor at Crispidea. In this episode, we'll talk about the global economy scenario, the impact of tariffs, the different sectors' performance, and the earning season in India and US. And finally, we'll talk about how it all impacts an individual investor.
Thank you so much for the introduction, Sanat. A quick disclaimer: the podcast is for informational purposes only and does not count as investment advice. So, do consult your investment advisor before taking any decisions. Also, the directors and associates at Crisp Idea may hold positions in the stocks we mentioned in the podcast, and the views shared are based on individual analysis. Thank you.
So, Malay, to kick things off, can you start off by giving a quick summary about the how the global economy is performing in early 2025 and how that is affecting the investor sentiment?
So thanks, Sanad and Venisha. So it's we are in a very interesting time at this juncture. We saw massive amount of volatility in the month of April because of trade tariffs. We are seeing politics, especially in India, heating up as well as some of the other regions of the world also have heated up in past. But even before any of these events happened, let me just give you a little bit of a kind of a broad picture view, right? So 2025, if you were to look at, the growth was already slowing down even before some of these events unfolded. And this is largely happening on the back of a very strong growth that the world economy witnessed post-pandemic era. So 20 all the way from 2020 all the way till 2024, we have seen a massive amount of growth, including some of the larger economies like US, growing quite significantly. But IMF was already forecasting US economy to slow down from the expected from 2024 growth rates of 2.8% significantly down. But now in April 2025, they've even revised this growth downwards. So now this growth rate is expected to be 1.8% in 2025 for US economy. They also expect Euro region to slow down as well from 0.9% to 0.8%. Even some of the fastest growing economies like India, is expected to slow down from 6.5% down to 6.2%. And even China is expected to slow down, right? Largely on the back of tariff war that we are seeing from 5% to 4%. So the macro backdrop that we are all in at this point in time is a slowing world economy. We believe even the US economy, which is expected by IMF to grow at 1.8%, may actually come down to close to 0% by the end of the fiscal year. The reason is, if you see in quarter one, the US economy is already contracted by 0.3%, right? And there was a 0.4% positive growth expectation in quarter one, but against that positive 0.4% growth rate expectation, it is now negative 0.3%. So US economy is already seem to be in contraction mode. And I think the backdrop is that we are in a world where the growth is slowing down. And now we have added more layers of complexities on top, right? Whether it is inflation, currency movements, interest rates, and so on and so forth. So that's the larger picture view from the global economy standpoint.
So, Malay, how is India holding up in comparison? So, 6.2%, as you just mentioned, seems like a very good growth in a slowing economy, global economy, isn't it?
Yeah, so India, of course, is one of the fastest growing economies, even at this particular point in time. It did have a bounce back if you compare July to September of 24 to the quarter of October to December. It basically had a bounce back from 5.6% all the way to 6.5%. We have not yet seen the quarter one growth numbers from Jan to March yet. But India continues to grow faster than the rest of the world. So that's given, absolutely given. But the long term growth expectation of India is 7% and above, and that's the true potential of the India as a market, right? If you were to look at the demography, you look at the capex cycle and so on and so forth. So India has slowed down from its long term potential, and at 6.2%, it is still below its as I mentioned, the long term potential. So yeah, it is growing faster than the rest of the world, but below its potential average.
Okay. Thanks for laying out the big picture, Malay. That really sets the stage well. Now let's move on to the one of the hottest topics of this quarter, that is tariffs. Can you please share your views on the impact of tariffs throughout the businesses all over the world?
Yeah, no, I think the tariff, of course, we saw a massive amount of volatility once the tariffs got announced. There was a rollback which happened. There was a pause which happened. There were certain exceptions being made. So, I mean, it kind of played out all throughout the month of April and even in the month of May as well. But if you look at the history of tariffs, they don't have good outcomes. If you were to look at some of the past historical events, the closest that we have got is Smoot-Hawley Act in 1930, when the U.S. government had raised duties on more than 20,000 items. It's being said that it actually kind of pushed, or accelerated the whole global depression which was happening at that point in time, and the US exports almost fell 61% at that point in time. So, if you were to just look at this historical context, and if you were to say that, hey, if this tariffs were to kind of repeat the history, then probably it will not go down well. The issue is not just the increased prices for consumers, but there are multifold impact of tariffs on multiple different dimensions, right? So, of course, one is consumers pay more price on the retail shelves, so it's almost a tax on consumers in some sense. But the impact is the lower strata of the economy that you see in the US market, was already under stress. And now when they see a higher shelf prices, the chances are that they will purchase less, right? So the demand will slow down, the growth will slow down. Growth will slow down and demand will slow down. So that's one impact that we will have. The other impact is, once if the trade itself comes down, then the countries which were purchasing US securities, right? Let's say China, Japan, India, Russia, not Russia as much in the recent past, but China, Japan, and India, if they purchase fewer treasuries, or they need to purchase fewer treasuries because now they don't hold as much dollars, with them, then what ends up happening is that the yields remain sticky, right? The bond issuance which the US government kind of does every year, they will have to do it at a higher price, which again has a cascading impact that the interest rates that the US consumers will pay will be higher. So now there is a double whammy impact on the US consumers. One is they are paying higher prices, they are spending less, and third impact is, if they want to finance or make any purchases with finance, then they will have to pay a higher interest rate as well. So all of this will further result in the slowing growth, and then that kind of cycle, goes into more into a recessionary cycle. So we believe that, yeah, these tariffs will have multifold impact. Recession, we almost feel it's kind of guaranteed. We don't know how shallow or deep it will be and how long will it last, but we do forecast that there will be a US recession. And then there will be other consequences around the bonds and the interest rates, which will potentially remain high. Inflation potentially will also remain high, and the fiscal deficit situation in which the US government finds today, that they are running some of the highest fiscal deficit, will also make it harder for them to have any stimulus or policy response associated with that as well, right? So potentially there will be also an impact on the currency, which is already we are seeing depreciating by 6 to 8%. So there is multifold impact on the US market because of tariffs. All of it potentially is negative.
So, Malay, there's one kind of war going on in US right now, that is tariff wars. So, what about the current war that is going on currently in India? So, what are
Yeah,
your
the actual war that is happening here.
Yeah. Yeah, so geopolitics, of course, have heated up between India and Pakistan, as we all know, right? There were other multiple theaters which were already at play, whether it is Russia, Ukraine, whether it is Hamas, Israel, and so on and so forth. Maybe there could be a few other, theaters which could open up in future, which could be like China, Taiwan, and so on and so forth, right? But I guess if you were to look at the long-term history of Indian market, India has seen wars in past as well. We have seen Kargil War, for example, in the recent memory. But Indian market have seen through most of those situations, right? And some of the situation also tend to be relatively short-lived, compared to others. Also, it's very difficult to predict an outcome of a war, right? People thought that, hey, Russia Ukraine will get over within few days or weeks, but it's still currently waging on, and we don't know till what end. So it's very difficult for an investor to predict the outcome. But if we are to look at the long-term history of Indian market, we have seen through wars, we have seen through changes in government, we have seen through changes, basically challenges that we had associated with currency, inflation, so on and so forth. The markets have been very resilient and continues to do well on the back of course, strong underlying dynamics, and that's what we believe would be the long-term future of India as well. But yes, short-term there will be uncertainty, there will be more volatility in the Indian market.
Okay, yeah. So, zooming in, so are these tariffs already showing up in the results of the companies? And we know that the current earnings season is underway. So, what are they telling us?
Yeah, no, I think it's a good question. So let me kind of show you a little bit of a picture. I think the earnings season in India is still underway. It's not fully out. We are right now sitting on 9th of May. There are when we did this analysis about few days back, only 81 out of 500 BSE companies had reported their earnings. So there's still more earnings to come out during the rest of this month. But when we just look at, if we look at these 81 companies, the growth was slower than what we expected. So there was only 6.3% median growth on the earning side of the companies which reported their results, which is even below the 8.5% growth rate that we had seen in the last quarter, for example, which was, by the way, also lower than the long-term average of Indian companies growing at about 12 to 15% their earnings on a year-on-year basis, right? So earnings definitely look slower than its long-term average. The revenue growth also was only 4.1% at a median level, which is very unlike a growth market like India. So India definitely seems to be in a slow lane at this point in time. The expectations were muted when we went into this earnings season, but yeah, at a median level, it seemed to be on much on the lower side than expectation.
So, Malay, can you break it down a little bit more for us? Which companies or sectors are standing out for better or for worse?
Yeah, so if I were to look at India, right, I mean, if I were to first look at some of the larger companies, there's been a bit of dispersion in terms of performance. Technology sector is not doing that well. So Infosys had a negative 11% earnings growth. TCS also is having negative earnings growth. HCL had a meager 8% earnings growth. So I think the tech sector seems to be under stress for sure from an earnings standpoint. Even Reliance, which is massive, right, and has a massive amount of play both on B2B as well as on B2C side, had a meager 2.4% earnings growth. So the large companies didn't seem to do that well. Exception was a little bit of banks, like ICICI Bank had a really solid growth of 17% on a year-on-year basis. HDFC Bank has done well. Private sector banks seem to be doing well. So banking is one area which seems to be doing better than the other sectors. But if you were to look at, and of course, some of the smaller banks like Bandhan had good results, Trent had good results, pharma companies had reasonable results, etc. So I think some of those companies, in the mid caps have done relatively better. But yeah, overall the growth, as I mentioned, at a median level seems to be on the slower side.
Okay, so Malay, you just talked about the sectors that are doing well. So, what about the sectors that are not growing or not doing well, or the decliners in the quarter one?
Yeah, so there are quite a few companies which had negative earnings growth in this quarter. I think the one sector which stood out is uh, microfinance. Banks which had exposure to microfinance. So if you see here in the chart, Equita Small Finance Bank had negative close to 80% growth. Ujjivan Small Finance Bank had a negative growth. Utkarsh had a stressed uh, microfinance lending book that they had. Traditionally, if you see banks, they value their loan book anywhere from 3 times to 7 times of the size of the loan book which they are having. But Utkarsh sold their MFI portfolio, which was a distressed portfolio, at just 15% of the loan book size, right? Which is much, much lower, which is indicative of the size of the stress in that particular segment. There are a few other companies which didn't do well. Companies like Zomato, which is now renamed as Eternal, had a negative 80% earnings growth, although they did well on the revenue growth. There are a few other companies like Tata Consumer Products had negative earnings growth as well. So it does seem that Indian urban consumption still seems to be under stress. Realty sector also didn't do well, although we were quite bullish on the realty and consumer cyclicals. But yeah, there are a few pockets which are not doing well, in the Indian market.
Okay. So interesting to see how things are unfolding in India. So if we shift our focus to the US and how things are there in how their earnings season is stacking up. What are your views on the US earnings?
No, I think it's very surprising to see US results, right? So, in fact, there are more companies in US who have already reported their earnings. More than 350 companies out of S&P 500 companies have reported their earnings. Um, Out of those companies who reported their earnings, they had a great blockbuster earning season. So their earnings grew by 16.9% on a year-on-year basis, which is again following on the back of two great quarters that US companies had. So that has been very, very positive. On the revenue growth, however, we saw a negative revenue growth in the US market, which is very similar to the US GDP growth as well, right? So, in some sense, the US companies' demand is tracking, the rest of the economy. But on the earnings side, maybe the companies did very well because they have a very strong competitive moat. Their business models are very resilient. They are able to squeeze more out of productivity and efficiency on the margins improvement side and so on and so forth. So that's maybe one reason why the earnings growth is still solid while the revenue growth is declining. But overall, it was a good growth. We don't expect, however, this growth trajectory to continue in future. The earnings expectation of S&P 500 companies is still quite elevated and have not been revised by analysts. But if you see some of this continuing tariffs, pressures to continue, as well as slowing demand, stickier inflation, higher bond yields and interest rates, it will show up in earnings decline as well in the coming quarters. So net net, I would say great quarter, but may not hold up, in quarter two to quarter four.
So, how are the sectors performing in USA? You just talked about the sectors performing in India and how the US earnings season is turning out. What about the sectors in the US now?
Yeah, so again, quite a bit of dispersion in terms of performance. We were quite surprised to see healthcare doing really well. Of course, they are not affected by tariffs. So healthcare sector grew by 57% their earnings on a year-on-year basis, which is a great performance. The tech sector, again had a great quarter. I mean, we saw announcements from Amazon, Microsoft, Google, Meta. All of them had good results, and their earnings again they are being able to generate positive earnings as well. Financials continue to do well, although if there is a recession, then they may get affected in future. The sectors which didn't do well was largely energy. It's a well-supplied market. The crude oil prices have come down, so again, energy seems to be under pressure. But net-net, I would say that the hyperscalers are still hyperscaling. Some of the largest companies are, of course, all hyperscalers. Amazon had a 62% year-on-year earnings growth. Meta had more than 35-36% earnings growth. So all of Microsoft had good results. They are able to grow their cloud revenue quite well. So the larger companies, larger tech companies seem to be still holding up quite well in the US market at this point in time.
That is great, Malay. So, for a capital market investor in US and India, how should an investor position themselves, or which sectors look very favorable for investments at this point of time?
Yeah, no, I think it's a great question. I mean, that's ultimately $1 million question, right? So, what do you make of all of these earnings, global economy, and what should investors really do? And we have some thesis around it. So, if I were to give you a quick view from an India market perspective, right, there are a few sectors that we really like at this point in time. One of the sectors which really stands out for us is capital markets. By capital markets, of course, Indian investors were always focused on banks and BFSI broadly as a segment or lending as a segment. But the sector that we really like is more on the capital markets, which are the stocks associated with things like stock exchanges or services around, let's say, IPO. Or if you were to look at mutual fund companies. Now, these are all, I mean, of course, Indian capital markets is deepening, financialization is increasing, retail investors are putting more and more money through SIPs into mutual funds. So, all of that, there is a positive kind of tailwind for that particular segment. And what we really like about that segment is high returns on equity. What we also like is some of the companies have monopolistic situation, right? So we have only two exchanges, as an example, Bombay Stock Exchange and NSE, National Stock Exchange, and only one is listed, the other one is not. Similarly, if you look at companies like CAM, CDSL, in the areas in which they are operating, some of them have 50%, 60% market share as well. So we really like that particular as a theme to play out. That's one theme that we like. Of course, as I mentioned, banks have done well, and we especially like private sector banks. So that segment is doing well. Pharmaceuticals was a little bit hit because of potential headwinds around tariffs. But if tariffs were to get resolved and India and US are in advanced stages of discussions on the tariffs, again, that sector could do really well. We like pharma broadly as a sector. Exporting industrials have done well. One sector which didn't do well, we are hoping is more of a blip, is real estate and consumer cyclicals. If our urban consumers basically get back in the market and start spending again, that sector could do well as well. Now, on the downside, if you were to really look at India, as I mentioned earlier, IT and BPO is, of course, are facing a lot of headwind. A, because of AI. B, because they are not able to win large deals. And of course, US, B2B environment seems to be, kind of slowing down their IT spending as well. Energy is well supplied in Indian markets as well. So those are few sectors which potentially we have a slightly negative tone to it. But on the other hand, if you were to kind of compare and contrast, US is a bit different than India as far as technology is concerned, because the US tech companies are massive behemoths, very sticky business models, and of course operating at a very large scale also on the AI side. So that's segment we kind of like it, largely represented by hyperscaler, value tech companies. The other segment in US, which is classical enterprise software companies like, let's say, Salesforce or Adobe or Oracle, etc., have very sticky business models. So people, when they cut down on enterprise spending, they still need their core software to continue to run their business workflows, etc. So that segment will probably be more resilient than the other segments. Domestic healthcare is completely kind of shielded from tariff situation, relatively speaking. So that is again a positive segment in the US, and defense, largely because of the geopolitics around the world, could also do well. And on the downside, again, the sectors like energy, as I mentioned, is still well supplied, so may not do that well. Materials is not positive. Real estate in US is not positive, largely on the back of very high interest rates. So consumers, or the new housing starts are not very encouraging. The housing sales has not been. It's practically a frozen market for quite a bit of time. So those are the segments that we believe that in US may not do that well.
So we have seen that the both the India and the US markets have bounced back from their lows. But do you think the current market bounce is justified, or I mean, the market looks a little pessimist about the bounce back. So what are your views on that?
Yeah, no, the markets are actually are kind of ignoring all the negative news, and they've really bounced back from their lows, right? So US S&P 500 made a low of 48.95 or something, and today it's more than 5,700. So roughly, almost a 20% kind of bounce from its lows. Similarly, in India, it has also made a 15 to 20% bounce back. So they are ignoring a lot of negative news. But I see challenges for the market in the sense, as I mentioned, India, the earnings growth are not commensurate, with the valuation. So there are certain pockets which are highly valued. So one has to kind of pay attention to that. Overall earnings still seem to be in the slow lane as far as India is concerned. US, of course, people are ignoring potential downside risk associated with tariff and recession and interest rates, and other currency and kind of the foreign money flows scenario. So markets are currently ignoring. So we do believe investors should be cautious. This bounce back may not be sustainable, but there are certain pockets which are still quite attractively priced, and investors should of course look at their risk profile and make a decision in terms of what suits their kind of risk appetite.
Yeah, that's a fair take, and it brings us to some of the current hot trends also, particularly around gold, global giants, and safe bets. So, gold is making headlines again, and possibly hitting $3,200 an ounce. And so, why is gold so attractive right now, and who should consider allocating money to it?
Yeah, no, gold has done fabulously well, right? Isn't it? I mean,
Yeah,
in Indian terms, it is almost what 1 lakh
almost
and
a lakh.
above per 10 grams, right? So it's quite it's of course had its very nice run over the last few months. But gold, if you see who are the buyers, right, for gold. So there are two sets of buyers. One set of buyer is, of course, the retail buyers in India and China. Largely, these are the two markets, which keep buying gold on an ongoing basis. The other set of buyers, which, however, have emerged in the recent past, are central banks. So countries like China, Japan, even India, right, who have their own forex reserves. They would either invest in foreign treasuries, like they've been buying a ton of US treasuries. But when you look at, they will diversify the reserves, right? So especially if people are now negative on, let's say, US as a forex currency, or the trade is coming into a war situation, so China may buy less of US treasuries. They will diversify and they will buy gold, and that's what they've been doing. I mean, the prices cannot go this high just because on the back of retail buying. So the central banks have bought a lot of gold. Also, gold is a good hedge at the time of inflation, uncertainty, etc., which has been kind of proven over many years. So I think it is definitely an attractive asset class. We do advise our investors not to look at the short-term price and then invest in gold. It could even drop from here, or it could even rise from here. But a sustained allocation towards commodities, precious metals, between 10 to 20% on a month-on-month basis, I think is a good kind of strategy to hedge against currency movements, hedge against inflation, etc. as well. And by the way, gold is not just the one precious metal, right? The other precious metal which is now coming or making a comeback is silver. Right, so silver, of course, is an alternative to gold. uh, and the advantage of silver is, while central banks may not buy silver, but there are industrial use cases for silver. It's being used in electric vehicles, for example. It's being used in potentially also in mobile phones and so on and so forth. So there are industrial use cases, and so investors could look at both gold and silver as a hedge. Between two of them, they could look at allocating 10 to 20% of their total investments allocation into that asset class.
Okay.
Okay.
So if we look at it, you just talked about the gold and silver as an asset. So what about real estate as an asset? So what are your views on other asset allocations that we should look on?
Yeah, so real estate has been one of the very popular investment vehicle for, especially for Indian investors. I think Indian investors have sometimes gone overboard and allocated, and they have very high exposure to real estate. Some of our clients have 60, 80, 90% allocation towards real estate, right? And that has done well for them in past. There are two disadvantages of real estate. One is, of course, it's an illiquid asset class. So let's say if you want immediate liquidity, you can't kind of sell off. It's also very lumpy, right? So you can't, like, you can sell one share, but here you can either buy the full plot of land and sell full plot of land, right? And the third is, the forward returns of real estate may not be as attractive as in past, because the prices have gone up quite substantially. So the people should moderate their expectation of what they can expect from real estate investments from a go forward standpoint. So those are some of the downsides, as far as the physical real estate is concerned. But one additional asset class which is now emerging is commercial real estate, and that is available in form of financial investments. So what are those financial investments? One can buy REITs, for example. So as you know, commercial real estate, when tenants occupy, like a commercial organization, like companies occupy a space, they will tend to pay rental payments, and that yields are as high as 8% on a year-on-year basis. So you can take exposure to that play through REITs. Similarly, there are now more real estate AIFs coming into picture, where you will not only get those 8% yield on investments, on the rental yields, but you will also get capital appreciation in form of the when the asset prices go up, and when they buy and sell the entire buildings, then one can play, and then you can buy a fraction of that real estate through that AIF, right? So of course, AIFs, you have to invest minimum is 1 crore, but that is one way you can take exposure into real estate market. So there are more opportunities available. But yeah, overall real estate, I mean, of course, it's a good investment, but one should, of course, look at not making a disproportionate investment to real estate. We believe equities will, still should be favorable, but this is a good, diversification in any investor's overall portfolio.
So, talking about gold, that reminds me of the 7 golden rules mentioned in your report.
Right.
Can you please throw some light for us and our viewers on the rules for investors?
Right. Yeah, no, we did come out with this Q1 CY25 report, but we also added a little bit of, like, it's not specific recommendation, but kind of overall strategy that investors should follow. And we came out with this 7, kind of points of view. Some of it are time tested, so this may not change on a quarter-on-quarter basis. But like the first point is, I mean, India, of course, is a great market for long term. We do believe in the whole story that India will become the the third largest dominant economy in the world as early as 2030, and become as large as 25-26 trillion dollar economy by 2047. So that theme will continue to play out. Short term, there will be volatility, there will be uncertainty, there may be drawdowns as well, but this is one theme that people can play. The second associated point is equity investment is inherently risky, so which means that it's not meant for everyone. There are periods when you can even have a loss of principal when you are making investments in equity. In 2008, for example, we had seen drawdowns as high as 50% in investors' portfolio, in some cases even 70 to 80% as well. So when one is investing in equity, they should be aware of this, and only it makes sense for long-term investors, right, who will be patient, who will kind of play on the long-term theme. Um, the third associated point is, in India, there are always some sectors which tend to be, kind of fashionable. At certain points in time, like renewable energy became very fashionable, defense sector was fashionable, e-commerce became fashionable for certain periods of time. So one should watch out for, the long term potential of that sector, and also the valuations as well, because for a short periods of time, if you just follow a certain trend or a theme or a fashion, you could end up losing a lot of money as well through that play. So we just ask people to be cautious and not follow the herd mentality there. The fourth part, we talked about diversification. So equity, real estate, debt, gold, all of that, I mean, is AIFs can play. And so and that's important. So asset allocation is important, but even when you are investing in equity, you should diversify. So,
Different
so in
sectors.
multiple companies, multiple sectors as well, that would protect the downside to a certain extent. And the other point that we are seeing is large caps at this point in time are better positioned, largely from a valuation standpoint. We still believe there's a lot of froth in mid caps, but large caps are attractively priced compared to its own historical valuation. So that segment seems to be fine. And last but not the least, if you are an equity investor, tracking is very important. You have to see how companies are performing on a quarter-on-quarter basis. Are there corporate governance issues? Even if you're investing in mutual funds, what's the quality of the fund manager? And that's something that a financial advisor can best provide those services. So do work with a financial advisor. If not, one should track this quite actively. Yeah, so those are the seven kind of nuggets that we are kind of we have broad recommendation to our investors to keep following, you know, in the market.
Thank you so much, Malay, for throwing light on the golden rules.
Also, Sanad, one more question for Malay. So, Malay, if you had to leave our viewers with one core piece of advice to navigate the markets in 2025, what would it be?
Yeah, no, I think it is definitely is a challenging year. We are seeing transitions on multiple fronts, countries, currencies, commodities, equities. So yeah, we seem to be in a era of heightened uncertainty. We could see more volatility. But as I mentioned, right, I mean, we have seen times where there were wars, there were government changes, there were currency challenges, but Indian markets have been resilient all throughout. And I think if one were to take a long-term view and follow a sustained discipline, while ensuring that they are still cautious and not taking any kind of risky bets, or they are hedging their positions relatively well, I think long-term investor will continue to do well. So this market will also offer lots of opportunities for people to take certain positions for a longer term period, but do watch out for uncertainty and things as they unfold. It's best people stay calm and not take any knee jerk reaction. But yeah, it is going to be definitely a very interesting year. We will also keep monitoring these trends and keep doing this kind of session every quarter, so that we are able to provide the state of the union to all our viewers, as well as to all our investors, in terms of how the quarter kind of pans out, and if you need to take certain corrective action. But we hope that these insights were helpful and valuable, for a viewer and an investor to, and then take appropriate positions relative to their portfolio.
Yes, thank you so much for sharing this advice. I think it's very useful for our viewers. And thank you so much for breaking this. Also, the link for the report is in the captions. So, do read our report and share your views in the comments and subscribe to this video. Thank you.
Thank you,
Thank
guys.
you.
Appreciate it.